Welcome to the Multifamily Investor Nation podcast. I'm your host, Whitney Elkins Hutton, the Director of Investor Education here at PassiveInvesting.com. And I am so excited to have on the podcast today, Will Matheson. Will, welcome to the show.
Thank you for having me.
Excellent, excellent. Well, before we dive into the details of Creekside Villas, 21 units in Boone, North Carolina, tell us a little bit about yourself, what your background is, and how you got into multifamily real estate.
So, my background is my first job out of college. I was a broker for Marcus and Millichap out of their Raleigh office in North Carolina, primarily doing retail, but we ended up doing a little bit of multifamily and a little bit of student housing, specifically in Boone, North Carolina, which is how I ended up buying this asset we're going to be discussing later. My brother, I have a twin brother, Evan, my partner at Matheson Capital. We decided we wanted to get into ownership. So we left brokerage 2017, went to Columbia University's Master's in Real Estate Development program, and started buying assets in 2018. Since that time, we've bought 13 assets. 14th will be hopefully closing soon, seven of those assets we've already sold.
Awesome. That's impressive. Well, let's dive into the details of Creekside Villas, 21 units in Boone, North Carolina. You closed in September of 2022, but let's back up the timeline a little bit and discuss when you found the deal and how you found it.
So the deal was brought to me by Kyle Chase, K Chase, based out of Charlotte. He brought it to us off market, and Boone is a market we really like. Like I said, going back to our brokerage days, it was a bit of an interesting story. When a broker tells you the rents are, 30% under market, you kind of have to scratch your head about that. But he was able to make a pretty convincing case. We went up, we toured the property, liked it, and started working on a contract right away.
All right. Well, was there anybody else looking at the deal, or was it just you guys?
Well, I like to think it was just me. As far as I'm aware, I wasn't competing with any additional offers.
Okay, awesome. Well, that makes things a little smoother. So tell us how you structured your offer. And how many times did you guys have to go back and forth before you finally landed on an offer? And what did the offer end up being?
So we bought the property for $7.6 million, which comes out to so it was 20 units plus a lease plus an office at the time we purchased it. So not counting the office, we were paying $380 a unit, which sounds astronomically high. These are luxury townhomes, 2-bed, 3-bedroom, like heated bathroom floors, nature trail on the park on the property with legitimately hand-carved woodland creatures on the posts in front of the doors. So I feel very confident in saying they're the nicest for rent assets in the market. So a little context there. But yeah, we ended up at we had a little bit of a back and forth. I can't recall where we started, but we ended up at 7.6, and we actually had a big sticking point in the negotiation because the leasing office or the office had all of these new appliances that had been purchased but not installed. And the story was that the previous owner, had essentially just bought them because if he was on vacation, he was managing it himself. And a tenant, had an appliance fail, he didn't want to have to deal with it. So he just bought all the appliances and put them in the office in case someone needed one. So we had about a 2-week hang up over negotiating that specific issue of would the extra appliances convey with the sale. We also had a back and forth over who was going to pay the broker. And I said, please just build the commission into the price, because if that happens, it can get financed. Whereas if, we're paying the broker, we have to raise the equity to do it, as opposed to getting the bank to fund 70% of it.
Well, so did you get the appliances in with the conveyance of the sale? Did they convey?
We did. We got all the extra appliances to convey.
And so just out of curiosity, like if he had used funds from the project to purchase the appliances, wouldn't they be part of the sale anyway? I don't know.
I mean, he was the sole owner of it. It wasn't like he was the developer. Actually, he was the original developer. He'd owned it for 15 years. I don't believe he had any partners. So, they're his appliances. And he said, well, I'm happy to go sell them. like I don't need to convey these. These are worth, $40,000 or whatever the number was. So it was the most unusual sticking point we've ever had, but we were able to come to a resolution and get it done.
Awesome. All right. So let's also talk about the business plan. So you saw the 20 units with the leasing office. I imagine you're, for a 20 unit property, you're like, we can convert that into a rentable unit pretty immediately. What was the other parts of the overarching business plan with this property?
So as I mentioned earlier, it comes to us and we're being told the rents are 30% below market. And at first we didn't believe it. And we went through the comps and we talked to our property manager in the market, a group called Boone High Country Rentals, who I can't recommend highly enough. And we went through the comps and we said, yeah, these rents are legitimately 30% below market. So what did we end up doing? We closed in September, even though this is not a student housing asset, because the Boone market is so dominated by Appalachian State University. The leasing cycle is really driven by the student market. So all of the leases start at the end, they end at the end of July, they start at the beginning of August. So we knew that we couldn't raise the rents for a year after we bought it, but we're pretty much at that point. New leasing cycle, like I said, we're recording this July 21st. The new leasing cycle starts in August, and our rent growth is going to be about 67% in 1 year, proving that they were under market. And we also, the only other aspect of the business plan was converting the office unit into a residential unit, which involved rezoning parcel of the property because it was chopped up into condos. It took us almost 6 months just to get through a rezoning of that parcel. But look, when you can increase your unit count by 5%, you can spend 6 months on it.
Awesome. All right. So your offer, let's go over the final details of the offer. What got accepted and the timeline too that's in the offer.
So the price, like I mentioned, we ended up at 7.6 for everything. The timeline, as I recall, I think we did a 30-day due diligence, a 30-day closing with a pre-negotiated 30-day option to extend the closing. That's something that we always try to incorporate into our offers, dating back to when I was broker at Marcus and Millichap, along the logic of, hey, look, everyone's happy when you're negotiating that first contract. If you're 45 days in and you ask for that extension, then they can always say no. So you might as well get it handled up front when everyone's feeling really agreeable.
Smart move, smart move. What kind of earnest money did you put down and when was it hard?
It wasn't hard until after the examination period. The exact earnest money deposit, admittedly, I can't recall. I want to say it was probably 2%, around 150,000.
Okay. Well, let's talk about due diligence. So you had 30 days to perform the due diligence. At what point in time did you actually step foot on the property and did you walk all the units?
Well, it was only 20 plus the office, so it wasn't too hard to walk them all. We got up there. We toured it initially, just some of the units. We toured those before even going under contract, and we toured it with our property manager, who has a full team. They do the maintenance in house, et cetera, et cetera. So we toured it with them reasonably quickly, title, all that stuff reasonably quickly. The most difficult thing in due diligence was getting a survey done, and I think that must have taken us over 2 months to get done. That's what delayed our closing. The survey took
Why is
forever.
that?
Supply
Why?
and demand, they're booked really far in advance, and there was some sort of miscommunication with the surveyor at one point where we were asking them, can you do this? Or like we asked a clarifying question and they never responded. So that lost us 2 more weeks of time. It was really annoying. I'm not going to lie, but we did get that survey done. And shockingly enough, the buildings hadn't moved. So everything was still good.
Was there anything surprising that showed up on due diligence?
I knew the most surprising thing, it was surprising in a good way. We knew the asset was really good. But when we're going through the due diligence and it's really being explained to us, like we were 3 times over the fire code or something like that. Like if and like insulation was 3 times the standard too. I'm not an expert on fire codes, but if you're supposed to be like R19 or R17 in terms of like fire insulation, I think the property was R57 or something to that extent. It was incredibly well built property, really, really impressive. Now, the irony being there was that winter storm that hit us all in December, caused the whole Southwest debacle. We still had a pipe burst because it was -20 for 3 straight days. So despite all of our insulation and our quality, we still did have one pipe burst.
But one pipe burst.
Only one, there were quite a few other properties in that market that had some issues with that. So we're grateful that it was only one unit.
Awesome. Awesome. Well, not awesome that it burst, but I'm awesome that you guys were hedged a little bit going into that storm.
It
So
could
that's
always be worse, I could have had 20.
right, right. I remember asset managing several properties in Texas a couple years ago, whenever the whole power grid went down. So that was fun.
Good
Anyway,
times.
yeah, those are the fun times in real estate, right? So we went through the physical due diligence. Any surprises on the financial due diligence of the property?
No, it was honestly really straightforward. There was one surprise that came out later, I guess. We didn't realize this until after we closed, but we had to increase our trash contract after we closed because apparently the prior owner used to jump in the dumpster to compact the trash so he wouldn't have to have it picked up as frequently. So we had to double our trash pickup. So that was a surprise that did not come up through due diligence. Quite frankly, I don't know that I would have ever thought to ask the question, does anyone compact the trash between pickups? Um,
That's a new one. I've never heard that one before.
well, I'm trying to keep your listeners entertained. Um, so, but yeah, the due diligence was reasonably straightforward. Again, it was built in 2007. It was a very high quality asset. A lot of tenants had been there for a while, so the bank records are pretty straightforward. Everything was pretty straightforward.
Awesome. All right, well, let's talk about the lending. September 2022, not exactly the smoothest time to acquire lending on a property. What kind of debt did you put on the property? Was it private? Was it public debt, fixed rate, floating rate debt? Let's get into the nitty-gritty details there.
So I am very grateful to say that Matheson Capital has never, on any deal where we've been the lead sponsor, we've never used floating rate debt, which has really benefited us in the last year.
I can
So,
imagine.
yeah, it's been nice. I can't fault people for using floating rate debt. Everyone in the whole conventional wisdom in the market said that was the way to go. It's just a bit unlucky at the moment. The Creekside Villas was financed using bank debt from First Carolina Bank, my favorite lender. I think I've worked with them 6 times. Shout out to Greg Farrell and David Dickerson. They do great work. We ended up financing that with 4.7% fixed rate debt, 5-year term, 2 years IO with a 30-year amortization. Despite it closing in September, they had given us a term sheet, I want to say maybe June or July, and they stuck by that term sheet. They're just a great group to work with, which is why we continue to work with them.
Awesome. So were there any, was it recourse debt, non-recourse debt?
It was non-recourse.
Non-recourse. And then was there any prepayment, penalty, yield maintenance, lockout periods on it?
No prepayment, no yield maintenance.
That's awesome. So you're essentially
They're a great bank to work with. First Carolina Bank. Can't recommend them highly enough. You guys are in the Carolinas. I recommend speaking with them.
there you go. Nice little plug there for them. Well, you raised capital for this deal. So let's talk about the capital stack. How much did you get in lending, and then what did you raise?
So the loan was $5 million. The equity was $3 million. So we've always been a pretty low leverage group. So we're looking at 62.5% LTV there. Like I said, we raised $3 million of it with the sponsor putting in 10%. So the total raise from LPs being 2.7.
Okay. And then, how did you structure this with your LPs?
So we were using a typical 30/7 or 30/8 promote, 2% acquisition fee, 2% asset management fee. Fairly standard, at least in my understanding for this.
Okay, so that's different language than what some of our, a lot of our operators put it in. So for those people who are kind of new and listening to this, would you describe that 30/8?
So our investors, we would give them a preferred return of, like I said, it was either 7 or 8%. And that means that, let's just take $3 million of equity, let's call it 8%. That means every year we owe investors $240,000, 8% of 3 million.
Mhm.
And for every dollar over that 8%, the manager, the sponsor, has a bonus of 30 cents. Um, the logic being that if we don't, if we give you an 8% return, you're probably not going to be ecstatic. It's okay, it's not great. So we don't earn a bonus, so to speak, until we exceed that minimum threshold.
Mhm. Yeah, so I guess, for those of you who are listening, maybe a limited partner, essentially, what Will is saying here, it would be a 7% prof and then a 70/30 split on with cash flow and equity, it sounds like.
Yes.
Yeah. Awesome. And you already talked about the fees. So I have a question to slide in here. How did things go after acquisition? After you took, did a takeover on the property, any surprises there, or has it been pretty smooth sailing?
Well, outside of the trash, there wasn't really too much of a surprise. As I mentioned, we had to increase the trash contract. One of the things we did when underwriting the asset, we tried to be very conservative, is even though we always knew we wanted to renovate the office and turn it into a one-bedroom townhome, we did not we raised money to do that in the initial offering, but we never accounted for getting any revenue from it. So all of our projections had to do with just 20 units, buying 20 units, selling 20 units. So that now that we've been able to successfully renovate and rent the one bedroom, that's all gravy, so to speak. That's all a bonus to our investors. So I mentioned, the trash happened, the pipe burst happened. We were able to raise some of the rents prior to August of this year, but we also had some unexpected vacancies. But on the whole, property's operated pretty smoothly. We've distributed more money than we originally anticipated, and yeah, and we're just really grateful for the debt we have.
Awesome. Well, Will, I just have two questions left for you as we wrap up. And these are two questions that I ask everybody. What did you find was easy during this process that you thought would be a little bit harder? And then what did you find that was a little bit harder that you thought was going to be easier?
Hmm. So I would say I thought raising the equity was going to be a little bit harder than it turned out to be, which is just a great problem to have. Now, obviously, I think the fact that we had secured great debt and we'd owned multiple assets in the market beforehand really helped. We have very good relationships in that market, and we have investors who know the market very well and why we like it so much. So the equity raise was a little easier than I'd expected. As far as what was harder than expected, this is a terrible answer, but I mean, getting that survey was really difficult. Again, it delayed closing, and survey is not something you think of as, oh, this is going to cause me a problem.
Right? Negotiating appliances and surveys. There you go, guys. Well, Will, thank you so much for sharing your knowledge and expertise with us here today. If listeners want to find out more about you, how can they find you?
So they can find us through our website, which is mathcap.com, mathcap.com, short for Matheson Capital, obviously. And I'm pretty easy to find on LinkedIn as well, just Will Matheson, Matheson Capital.
Awesome. Well, again, Will, thank you so much for sharing your insights with us here today, and most importantly, your time. We look forward to following you on your future deals.
Well, thank you very much for having me.